Thank you so much for joining us today. We appreciate your time and attention as we learn more about navigating bear markets today. So I will start with a little bit of an overview of what to expect from today's presentation. Perfect. So we'll spend just a few minutes doing some introductions and an overview. And then Eric will kick us off with some perspectives on bear markets. I will come in and talk a little bit about navigating bear markets and the emotional and behavioral side of that. And then David will take it home with some of the actions to take and controllables inside of a bear market. And then we'll spend the last half answering client questions. And so please feel free to submit questions as we're going. There will be time as well, kind of in the middle for you to submit questions. And so we'll spend the last half really digging into those. So we look forward. Thank you so much for being here with us. And we look forward to talking with you today. So with that, I'll start with some introductions. I'll start with myself. I'm Emily Hazelroth. I'm a financial advisor here at Summitry. I have been in an advisory role for about a decade. And through that, I would say my specialty has really been in-depth full service financial planning, which has given me a lot of perspective into the investor psychology. And so, that's been really helpful through the past several months as we've navigated some volatility and this bear market, as keeping that psychology in perspective. So I'm going to talk a little bit more about that. And now I will hand it over to Eric to introduce himself.
Thanks, Emily. Hello, everyone. Eric Jungling here. I've been with Summitry for 15 years now, this August, and I was previously with Charles Schwab for 7 years. So I've seen a lot of bear markets and bull markets alike, and I'm just happy to be here to share my perspective. David.
Thanks, Eric. My name is David Langhouse. I'm a financial advisor here at Summitry. I've been with Summitry for a little more than 2 years, but I have worked in the wealth management industry for a little more than 8 years. And I am excited to talk with you today about exercising some of the control that we have during volatile times like we're in today.
Great, thank you both so much. So Eric definitely has the most tenure of the advisors on the panel today. So we're going to let him start by giving us some perspective of his previous experience in bear markets and some of the client relationships that he's had through that. So Eric, with that, I will let you start off.
Great, thank you, Emily. Let's just move to the next slide here. We're here to talk about bear markets, and there's no doubt investing in a stock market can be an emotional ride. It's certainly thrilling when markets are up, and sometimes so much so that when markets are up big, many throw caution to the wind, looking to take on much more risk than they normally would. There are those chasing the hottest trends, such as crypto assets and so-called pandemic stocks, looking for outsized gains. Everyone wanted a Peloton, right? So how did we get here? There were supply chain shocks coming out of the pandemic, which led to shortages across the board, and our subdued spending and monetary stimulus led to saving surpluses. After the threat of COVID started to wane, the desire to spend on goods grew. They were scarce in nature, but it also led to rising prices. As we switched into the summer months, our spending habits changed. Everybody was itching to get out of the house. Kids were begging to go to Disneyland. And so people took to the road and the planes, and they were willing to pay the elevated prices for airline tickets, fuel, hotel costs. It didn't matter because they had surplus savings and they wanted to get out. So this started the uptick that we started to see in inflation, and this started back in 2021. We started to see this to continue again in 2022 as more and more people felt free to spend their surplus savings. The inflation rate did peak out in June of this year at 9.1% on a year-to-year basis, with July coming in slightly lower at 0.6 lower, and then August following that about 0.2 lower. And the Fed, from the beginning, has been adamant but they will raise rates to combat inflation until they see a reduction into a rate that's closer to their target of 2 to 2.5%. So we're far from that at this point, but it doesn't mean that we haven't peaked out in June, and that's what some people think that has happened. We'll have to see where it goes, but for now, the Fed is going to remain strong in their message across the board. So what is a bear market? Let's talk about the definition of a bear market. A bear market is a broad decline of 20% from its peak. We reached this level earlier in the year, back on June 13th, with June 16th actually being the low point, being down about 24%. After that, we enjoyed a 2-month recovery period during July and August, leaving us down only 9% for the year. However, with the latest inflation readings, the Fed increases, we now find ourselves back to where we were in June, in bear market territory yet again as of yesterday. But bear markets, we know, are painful, and let's be honest, the most painful one is always the one that you're currently in. 2022 started off in a decline, and we spent basically 9 months in negative territory, making the current bear market feel much more painful than the COVID downturn, which was much more severe than our current decline, but it was much shorter in duration. And so we have not experienced a bear market of this length really going back to 2009. However, we have had 2 bear markets since 2009, which induced panic across the board. But because they are so short in comparison to where we are today, they're basically forgotten. But we've been through challenging times before, and let's be honest, we'll get through this one as well. So let's take a look at some of the largest market declines over the last 30 years. And let's take a look at the next slide, please. So as I said before, I've been through many bear markets before, and here are 7 of them on display for you to look at. Many of you listening today remember going through these periods of steep declines, but have long shaken them off. And yes, everybody was in a different period of their life when these occurred. But what I want to point out is, despite the sharp declines and the blood on the streets, please take a look at the 12 months following each one of these crises. There was a sharp increase that you could not afford to miss as an investor. There was no signal marking the end of this period and changeover into this trajectory upward, making timing the market not only next to impossible, but also a fool's errand in itself. Let's take a look at the next slide, Anne. Many of you have seen this next chart, and we've shown it time and time again. And the reason why we do that is because we think it always tells a powerful story. Not only are the 7 largest downturns included in this chart, but many other intra-year declines, which have occurred every year over the last 4 decades. Let's take a quick moment to look at the chart for 1982. How many of you out there remember what happened in 1982? And I'm not really looking for an answer. What I really wanted you to do is to see if you could remember what happened in 1982. And many of you most likely could not. But what matters most during that time period is, what actions did you take in 1982 to get you to where you are today? I'll now turn it over to Emily to continue our discussion on investor emotions and the market cycle.
Perfect. Thank you so much, Eric. So to build on that, that gives us a nice historical perspective. I'm going to spend some time talking about a field of study known as behavioral finance. That field is really having a big comeuppance right now. It's actually been added to the curriculum and exam material for the Certified Financial Planner license. And the field really addresses the fact that there is an emotional side of managing finances and of investing, right? People experience this to different degrees, and you might be listening thinking, I am not an emotional investor, but I would encourage you to keep listening, because there is likely going to be something that resonates with you in this portion of the conversation. a lot of people have, it makes sense that there are emotions tied to finances, because at the end of the day, this is money that you have worked hard to save. It's meaningful to you. It's providing for your life or the life of your loved ones. And so behavioral finances really urges us to consider, validate those emotions, consider those emotions, and address them, as well as the behaviors that they motivate. So we as advisors talk with clients who are experiencing a full range of reactions to the market and economic conditions that we're currently experiencing. So, we have the client who's, I've been through this before. I know I just need to put my head down. I've got this. We have a client who says, I've been through these before, but this one is hitting a little bit different, and I need a little bit of help through it. And then we have a client who this is maybe new for, right? This is either the first bear market that they've experienced, or it's the first bear market where they've had a substantial amount of assets. And so they basically need to know what they need to do, right? And I would argue that even those who are feeling the most cool and calm and collected are probably still a little bit uneasy checking account balances, seeing reports that the S&P went down X percentage on a day-to-day basis. And that discomfort and fear, that's a natural emotional reaction, and that's okay. But we do want to be aware that that fear can lead to things like hesitation, indecision, and reactionary behavior. And that's where we as advisors, that's our job, right? Is to help coach you through those periods, to make sure that the actions you're taking, that the emotions that you have are being validated, but the actions that you're taking are still in your best interest. So the guidance that you'll hear over and over from your advisor is to stay invested through a down market, right? And that's sound advice, much easier said than done. So let's just spend a quick minute unpacking what that means and why we say it. So if we can go on to the next slide. So this graph really shows the old adage that history favors those who stay invested, and kind of drives home the point that it's not so much timing the market, it's the time spent in the market. And so you can see here the journey of $100,000 over a 20-year period, and that 20-year period encapsulates from 2000 to 2020, which obviously there's a whole range of market ups and downs in that time. Obviously, the mortgage crisis is in there, '01 is in there, the Trump-Clinton election is in there, all of the a lot of many other additional ups and downs that either you might remember or you might not. But the story is that $100,000, if you just stay invested in a stock portfolio over those 20 years, becomes $616,000. Now, the next two graphs show what happens if you miss some of the best days over those 20 years. So if you miss just the 10 best days out of 20 years of investing, that $100,000 is now only $282,000. And if you miss the 25 best days out of 20 years of investing, your $100,000 is now only $134,000, which is $34,000 of growth over a 20-year period. Now, you are likely thinking, my goal, if I moved money out of the market, would not be to miss the best days, it would be to miss the worst days. However, unfortunately, those two things are very much hand in hand. So you can see over in that green box on the right that over the past 20 years, 24 of the 25 worst trading days were within the same 1 month period as the 25 best trading days. And so I can assure you that after the worst times in the market, you are still feeling bad. Headlines are still very bad. Under the surface, the market is recovering. Those most impactful days are happening. You don't know it yet. And so there is no breaking those two things apart. There is no timing the market. And so that's why we give that advice. And so it's very different understanding conceptually why it's a good idea to stay invested versus actually watching your savings drop 20, 30% and continuing to make the decision over and over to stay invested. So the next question is, how do we then manage our emotions and the behavior tied to those emotions? And so I'm going to share another graph that is a little bit more lighthearted. Go ahead. And so with this one, I'm going to pause for a second and just encourage you to read through it and try to identify yourself with one of these phases in the market. Think back historically and try to see where you've felt some of these emotions before. So I know that I personally can see myself in some of these, and that's somebody who's worked in the personal finance field in specifically an advisory role and has coached people through this for a decade, right? And I know that I have had several of these emotional reactions. I can think of very specific examples of them. So that's to say, it's okay to feel that way. It's okay if you look at this and think, you know what, I have thought I'm going to go all in, and then it turns out to be the top of the market, or I've panicked right near the bottom and said, I got to pull everything out, only to find out, looking back 2 years later, that was really the wrong time to pull out. Or maybe you haven't actually done the actions, but you've had the feelings, right? It's natural. It's okay to feel that way. We have all felt some of those unconscious pulls before. But really, our job as advisors is to bring awareness to those unconscious, pulls one way or the other, and to give us more control over the actions we end up taking as a result. So I'm going to kind of leave you with 3 pieces of advice that I always give my clients about navigating the emotions and the behaviors around bear markets. So the first piece of advice is, don't react to your current emotion, but remember your current emotion, right? So our job as advisors is not to make you white knuckle through bad market scenarios. It's not to push you to the top of your risk limit and force you to follow through, right? When the market is down and you are feeling uneasy and you are questioning decisions that you've made, talk to your financial advisor. That is what we're here for. And so, I would say it's very natural. Nothing makes you question your risk tolerance like a down market. But if you're really uncomfortable, talk to your advisor. Now is not the time to rebalance your portfolio, but it's possible that your advisor will help kind of handhold through this. And then when the market recovers, maybe you do a rebalance inside of that portfolio. The other thing that's kind of tied to that, my second piece of advice, is to review your financial plan in the down market. I have a lot of clients who tell me I don't want to look at my financial plan right now because I'm afraid of what it's going to show, given the fact that my accounts are down. Oftentimes we're pleasantly surprised that, clients are still able to reach and accomplish many of their financial goals, even when the plan is calculating in today's reduced account values, right? The other thing it's going to do is remind you why you're in your asset allocation, right? So you might have that thing where you're really questioning your asset allocation in this down market. Your financial advisor opens up your plan with you, walks you through it, and you realize, oh, that's why I'm in this asset allocation. It's allowing me still to accomplish my goals, even given the current financials or the current market situation. And you might feel reaffirmed in your decision to stay invested in that asset allocation. The way that I heard it best phrased to me is, you might pull at a loose thread if that's all you saw, but you wouldn't pull at that thread if you saw that it was part of a larger tapestry. And so that's why we always harken back to the financial plan. That's our goal, right? And that brings me to my point of advice number 3, which is to keep it all in perspective. This is not about the number on your accounts today. I know that a lot of people really get emotionally attached to that high watermark number. And of course, our goal is to grow your accounts over time. But it's not about that number today, right? This is about the ability to comfortably provide for yourself and for your loved ones and for your priorities. And that's why we keep going back to the financial plan. So maybe the numbers on the page look different today, but if you can still live the life you want to lead, you can rest easier for now, and you can let us worry about getting those numbers back up. So all that said, I'm going to hand it over to David to talk a little bit more about some of the actionable items and triggers that you can pull in a bear market. But I just want to kind of wrap up by saying it all comes down to what I just said. Whether or not you think that you're an emotional investor, you have likely had some reactions and made some investment decisions that would be driven by emotion. So our job as your advisors is to really guide you through times like these and make sure that we are confronting those emotions, listening to them, working with them, but not allowing them to govern our financial lives. And so with that, I'm going to pass it to David. And thanks so much.
Thanks, Emily. As we've talked about already today, during times of volatility, it can feel like the outcomes are completely out of our control. However, if we take a broader view of the financial situation and refocus on the items that we can control, That'll allow us to regain that sense of control that will foster us through any market experience. One of the biggest indicators, and please next slide. One of the biggest inflection points for any long-term financial plan can be your spending habits. Even if you've never needed or wanted to create a spending plan in the past, a bear market year can be the catalyst to review your own spending to ensure that you're using those dollars on things that add value to your life. There are various apps that are available to help you track your spending automatically. Your bank may provide this service for free. You can also take a more manual approach using the export transaction features available and a simple Excel spreadsheet, which happens to be my personal favorite. Identifying unused recurring transactions or areas that you could reduce the outflows allow you to reduce the pressure on your portfolio over time. If you've already reviewed those expenses and still feel like you're having a tough time making ends meet, don't be afraid to dip into your cash reserves. One of the biggest reasons we as advisors recommend having a cash reserve in place is that so during adverse market conditions or adverse life events, you have those funds there to use. If you list them in your mind as never touchable, they'll never actually become valuable to have. Even if you aren't worried about your personal cash flows, reducing spending in a down market can help increase your savings rate to maximize return on the upswing through regular periodic investments. When the market is going up, as it had for the previous decade, it's easy to be an aggressive investor. However, market pullbacks can really put a damper on the optimism that you had as recently as a year ago. Using this time period as a chance to reevaluate your tolerance, capacity, and need to accept risk can help alleviate the stress of day-to-day fluctuations in the market. It's okay, and as Emily mentioned, normal for your risk tolerance and capacity to change over time and be able to change with new experiences. If you'd been in an all equity portfolio for the last few years, but have bristled this year while equities have fallen 15 to 20%, perhaps that's a sign you've been too aggressive to start out. Having your financial advisor available to discuss those concerns can help you identify how making changes to that risk tolerance could be impactful in your investment portfolio. Next slide, please. Another action you can take during any bear market, and even more often if you'd so choose, is to review your portfolio for tax optimization opportunities. You don't ever want to find yourself in a situation that requires you to react to unexpected inputs. Rather, responding appropriately to any new environment that we find ourselves in. That means having made plans ahead of time for how to act during adverse scenarios, something our financial advisors here at Summitry do quite often through our financial planning approach. We work with many clients who were somewhat surprised by their tax liabilities when filing in April of 2022 due to the increased realized capital gains that we had during last year's market run-up. Due to the market performance since the pandemic-related sell-off in March of 2020, equity positions at a loss before the end of 2021 used to reduce tax liabilities were few and far between. However, in 2022, we've so far experienced a much different market, as you're all aware. Based on your personal tax situation, and especially if you're in a high income tax bracket now, you may benefit from realizing losses in your taxable account to offset gains to reduce your overall tax liability. Speak with your advisor if this option could make sense for your individual circumstances. We talked a bit earlier about implementing a spending plan during bear markets, and I want to revisit that concept here in conjunction with dollar cost averaging. Especially if you're still working or had some cash on the sidelines, creating a purchase plan to buy into a discounted market can increase returns when the market does eventually recover, which previously it always has. We don't know that that will necessarily happen after this most recent pullback, but over time, the stock market has shown to provide those positive returns. That also leads me to the suggestion that having different risk tolerance and risk capacity for different investments makes sense as well. If you have an expense that's coming up in a year or two, having it in an equity may not be the best place. However, if you know that the dollars, like in your retirement account, may be 5, 10, or 15 years down the road, having those allocated for more growth can definitely make sense. Many of our clients also have concentrated positions, whether that's from an investment they had made 15, 20, 30 years ago, or from their current employer through RSUs, ESPPs, or options. The best time to create a selling strategy is before a market downturn, and the second best time is now. Working with your advisor to create a tax-sensitive selling plan for your ESPP, RSU, or options can make it easier once we've seen adverse market conditions. Most custodians do have a feature like those bank records that allow you to download all the pertinent data in a CSV or Excel file that we can use to convert into an Excel sheet to help decide which of those shares would be most appropriate to sell, whether that's annually, quarterly, monthly, but making that decision before we know what the market's going to do can help us make a plan to enact those selling strategies. One of the strategies that you can employ if you currently have those types of accounts would be to sell at vest, where you're no longer holding that stock and you're already paying ordinary income tax on the value at the vest date. But be sure to keep in mind your personal tax situation, because many companies tend to default to only a 22% federal withholding, which may not be enough to cover your ordinary income tax liability, creating a need to utilize portfolio assets when tax time comes around. And also make sure to be aware of your wash sale rules when selling in an ESPP or RSU account, because those RSU vesting dates do act as purchase dates and can impact your ability to book that loss at that time. Those wash sale rules may disallow any loss if those vesting dates are 30 days before or after the sale of those company shares. Emily, back to you.
Perfect. Thank you so much, David. So we are going to move over into the question and answer portion exactly at the halfway point. So good job, team.